So in this video we're going to look at the incredible world of bonds. Bonds are basically paper issued by a government or a firm and could be viewed as IOUs. It's a way of a government borrowing or a firm borrowing. Okay. So if you issue a bond, the key thing is the number on the front. The face value, as it's known as, or the nominal value, is this £100 here. And that means that this £100 will be repaid at a fixed point called the maturity date. And if you hold this bond, you will get £100 on the date. So we should have got £100 the 1st of January 2020, and that's on the bond. Bonds can be very long term, so you could be 1 year, 2 year, 5 year, 10-year bond, 20-year bond, or longer. Okay, and so the maturity date is at some fixed point in the future. And then the other key thing about most bonds is you get a coupon, you get a regular interest payment. So on this bond it says 5%, and that means you get 5% of the face value probably every year. So you're getting £5 every year, and that will be called the coupon, and that is the interest payment. Okay, and that's £5, and that's known as the coupon. They're bought and sold on bond markets at the market price. The market price will definitely differ from the nominal value on the front of the bond, depending on, guess what, demand and supply. So the value of the bond will move up and down depending on the forces of demand and supply within the bond market. Okay, and therefore that determines its market value. So the key thing is, how do you calculate the yield on the bond? Or if you know the yield, how would you calculate the market value? And simply, to look at it simply, we'll just use a simple formula here. It can get more complicated, but we'll leave that out. Say the market price of this bond. Say it was issued when interest rates were generally around about 5%. So you issue the bond, it's paying about 5%, quite happy. And then say interest rates in the economy fall to around about 2.5%. So the prevailing interest rates fall in the economy around 2.5%. What happens to this bond price? Well, it increases, because if you get if you're getting 5% return, certainly going to be demand for this bond. So it'll move up in price, and it'll increase until it gets around about £200. So at £200, the £5, the coupon will be around, it will be 2.5%. So simply you divide the coupon, the £5, by the price, £200, to get the percentage yield. So you tend to find that bond prices and interest rates move the opposite way. As the interest rate moves down, bond prices will tend to move up, and vice versa. So for example, say further into the future, interest rates have generally gone up. Then people will pay less for the bond, and the bond prices will fall, and say if interest rates are at 8%, then it's likely we'd pay something like £62.50 for a bond with a face value of £100, because that's giving us £5, and that's equivalent to an interest rate of 8%, a yield of 8%. So use this simple formula if you need to work out the market price of the yield on a bond. And most bonds are long term, they're meant to be pretty safe, but of course it depends who is issuing the bond. So thank you very much for watching.